First, welcome everybody. Thank you for joining yet another of our virtual series here. If any of you were on earlier, we're seeing light at the end of the tunnel. So hopefully we will be back to in-person events here sooner rather than later. Some of that remains to be seen, but there's at least some hope on the horizon that we can all get back together and have some fellowship in person. The goal would be to continue to do events similar to this, our educational series or beer tastings, etc. Some of the lower key things that we can mitigate risk on a little bit easier than just some game watches and free-for-alls. So we'll be continuing to do virtual for the time being. When we will also be doing a transition back to the quote unquote new normal with future events where we will be doing some smart socially distanced events at some point, and then at some point in the future we'll be back to normal. Be on the lookout for some more events coming your way here in the near future. We've got some stuff planned, and we have also brought a couple of new folks on board to the network leader group that will be introduced hopefully here over the next couple of weeks or month. That will bring some fresh ideas and some new blood to the group. As always, if you are not already, please make sure you join our Facebook group. And be on the lookout for emails similar to this one about future events. If anybody has any thoughts on things they want to see done in the future, just let myself, Brooks, or Alex know, who should be getting on later. We are doing our best to give you guys a wide breadth of virtual events here, but eventually those coffers will run dry on our brains alone. So if you've got an idea for a good event that you'd like to see done, just let one of us know and we'll do everything we can to coordinate that. I'm going to hand this off to Rick Zwelling, who's our financial guru. And he's already done one session last year on budgeting. This is the second session in a series, and we'll continue to do some events with Rick in the future on various other topics. But Rick, I'm going to go ahead and hand it off to you if you want to do a quick introduction and then just kind of jump into your presentation.
Yeah, sure. And I think maybe make me the host so I can do some screen share. So great. Thanks for the introduction. I love doing this. I'm a financial coach. I have my own practice. And I'm not sure I call myself a guru, but I do like giving classes on financial topics. So we talked about with Brooks and Jay that home buying might be one that's the time is good. People tend to look at buying homes and selling homes springtime, summertime. With Columbus, I've been affiliated with affordable housing for a couple of years. And so what we have in Columbus is, and some of you may be aware of it and some not, that there's Columbus 2050. That currently our metropolitan area has about 2 million people. And the projection is by 2050, that's going to increase by 50%. They're expecting another 1 million people to move to Central Ohio by 2050. In order to keep up with that influx of people, we need to be building 14,000 units a year. And we've been building around 8,000. So if you've noticed, you see rents going up and housing pricing going up as well. And so with housing pricing going up, sometimes there's that sales sense of scarcity. Maybe I need to get into a house and make it happen. My objective today is, I don't think there's gonna be anything earth-shattering, but the idea is to maybe take a step back and really evaluate, should I get a home? Maybe not get a home. And so I'm not sure there's gonna be a whole lot learned from this, but I think it's an opportunity to double check. Because I think the worst thing that can happen is to get into a home that you can't afford, because then it's just nothing but stress. So I've got some interesting things. If you have questions, there aren't that many of us, you can just unmute and shout out your question. No, I'm good with all that. I can flow with it. And so this is my presentation. I'm not the most fluent on PowerPoint stuff, so you have to bear with me. But really, it's to buy or not to buy. That's the question. Do we buy or do we not buy? And so, are the things, if you're going to be looking at a home, is like, why are you looking to buy? Is it because everybody else is buying a home and just there's not going to be anything left for me? Or there's some other reasons? So just a step back to figure out, is this something that we should be doing? And really, can it be afforded? Can you afford it today? Can you afford it tomorrow? With the pandemic, we learned, nothing's for sure. And so do you have some flexibility in your finances that if there's a step backwards, that you get in a home, you can still be there and be somewhat comfortable? And how long do you plan on being in the home? If you're in a home for a year or two, don't expect to get your money out. It may happen, it may not happen. So don't look at it as an investment, look at it as a place to live. So freedom, I thought about, we all want levels of freedom. And so there's freedom both with renting as well as buying. They're just different types of freedom. So if you're renting, you're not tied down. Say maybe that a lot of people choose experiences over things. So I want to be able to travel a lot and just come and go. You don't want to be tied down. A lot of the apartment complex have very nice workout facilities. So you don't have to go and pay for a gym at Planet Fitness or Lifetime or whatever like that. And it's also nice that if you got a repair, all you do is pick up the phone and you have someone come out there and you don't have to worry about paying for repairs. On the other hand, having a home, make as much noise as you want, make any changes. If you're handy, you like to paint, you like to build out things, having a home's great. With pets and kids, an apartment can get pretty crowded. Privacy and not have to deal with annual rent increases. So there's freedom on both sides. So it's just really where do you fall out on this? And there's different housing options available. They're starting to build some high rises, so apartments and condos and townhouses. Not so much mobile homes as much anymore, but it's still viable. Non-financial reasons to buy a home. Your space. You want to have kids, children. You want to tear down. You want to tear down a wall. No landlord, no one telling you what to do. And you can situate yourself near work and school, and it's all good. And we're told it's the American dream. So sometimes we get bought into that, even though it's not everybody's dream to own a home. When it comes to financial reasons, it could be a long-term investment. Though you shouldn't look at buying a home as an investment, it is an equation. You can't get away from that. However, if you don't maintain the home, it's not a very good investment. And neighborhoods change, and we'll talk about not tapping into your home equity, the equity of your home. Stable monthly payments, especially now the interest rates are so low, you go with a 30-year fixed or 15 or 20-year fixed, what the payments are. Except taxes odds are we're going to go up. Condo fees. If you're thinking of a condo, I have friends who bought a condo, I lose track of time, like 8 years ago. About 4 years ago, they found out like the whole property had to have the exterior redone. So each unit had a $30,000 assessment. So just be aware, if you're looking at condos, you have the homeowners association and you have these assessments. So just kind of keep that into the equation, because you don't want to get hit. Like, I'm sure a $30,000 like over the top, but it did happen. Benefits, you get to deduct the interest rate on mortgages. However, that doesn't play as much today as it did a few years ago, because the tax law changed where they increased the automatic deduction. So if you don't itemize, I think it's like over $12,000 for individual and over almost $25,000 for filing jointly, married filing jointly. So the interest deduction on a mortgage doesn't play as much as it used to, unless you're buying a really big home or you have a lot of other deductibles, then it might be worthwhile. So I just wanted to throw that out there, that if you go to realtors, you go to mortgage people, they want you to buy homes, they want you to take out mortgages. So they may play up different aspects of it. So the mortgage interest deductible, not as important as it used to be. In terms of reasons to rent, don't have to deal with the repairs. The amenities can be really nice, just to get out, walk 2 doors down and you're at a pool. Lower upfront costs, first month and a security deposit. And then also the ability to change, the flexibility, and people like flexibility. And so it's something to be important. You don't want to be tied down. Lower insurance costs, utility costs are less. Don't have the ability to purchase a home, fine, and a lot less responsibility. It's not your place, turn in the keys, clean up the place, walk away, not your problem. So you want to look at the whole picture when you're going to look at a home, especially in the area of finances. How stable do you think your income is going to be? Do you have enough savings? I think it comes down to everyone's individual sense of risk tolerance and flexibility. Because I think it's a challenge. I think to go. You hear about people who are house rich and cash poor. They got the house, but you walk in the house, there's like nothing there. They have bed sheets over the windows, kind of like you did in college. So just make sure that you've got enough money. I'm going to touch back on the finance part for sure, but be aware it's not just buying the home. There's a lot of other money. You have the down payment, the closing costs can be $5,000 to $10,000 to $20,000 depending on the size of the home. The expense of the home, moving expenses, the fix up, and then as soon as you get in, there's going to be something that you have to fix. It's going to be the oh shit. So just have that financial wherewithal. There's no point in going to a home just to double up the stress in one's life. Also, once you move in the home, you have all these expenses taken care of. Do you have some money set aside for emergency fund? Typical experts say that one should have an emergency fund of 3 to 6 months. Well, maybe you buy a home, you're not going to have that. But from a budgeting standpoint, will you be able to rebuild your emergency fund? So that's really critical, looking at the finances really with a real microscope, making sure you're comfortable. So if you do pull the trigger and get a house, you're not filled with regret, and that you're willing to take on some of the stress of the newness and a bit of uncertainty. And just know monthly payments got insurance and real estate taxes, which tend to go up as the homes increase in value. When you buy a home, you're going to see a closing statement that has all these fees. Everybody's got their hand in the real estate industry, right? Jay and his wife just bought a home last year. So I'm sure you were a bit shocked at how much your closing costs were, especially title insurance. I always find that one's kind of interesting. It's like they go back and search records, and every time you refinance or get a new home, they research the same records. I think it's a bit of a it's a bit of a scam in a way, because you're paying for something that titles are almost never in dispute, but it's a fact, and you're going to have lots of fees involved in buying a home, and be aware. And the lender and the mortgage people will give you a sample closing cost, so you get a sense of what it would cost to close on the home on top of the down payment. So it's not cheap. Couple of terms to know: escrow. If they hold money back, the lender will hold money back to pay for taxes, to pay for homeowners insurance. Sometimes you can pay homeowners insurance yourself, or sometimes it's rolled into the payment. So they'll escrow, they'll take some money back just to make sure that these entities do get paid. So that's going to be part of the closing costs as well. And then if you have less than 20% down, in most cases, you're going to have private mortgage insurance. So it's an insurance premium that you're paying on behalf of the lender to make sure you don't default, that the lender gets their money. Anything over 20%, there's no mortgage insurance. But it does, if you're going to go with less money, I'm going to talk about that a little bit in a little bit. But just know you're going to be paying an extra fee because you have less than 20% equity. Things to consider: don't look at your home as a bank. Before the pandemic, I met with a couple in their 50s, second marriage, college educated, both making a nice income. And they were in trouble. They were netting around $9,000 a month. And by the time I done working with them, they found out they were spending like $12,000 or $13,000 a month. They kept using their equity line because they had a home mortgage, and then they also had an equity line. They kept pulling from the equity line. And so really, they didn't own the house. The bank owned the house. They would have been better off selling the house and moving to an apartment. So don't look at your home as a bank. And you're going to get all these mailings about, hey, cash out, you need to buy this, and use your home for that. And you do what you have to do, but I recommend not using your home as a bank. Set aside money for repairs. It's going to happen, especially if you're buying an existing home as opposed to a new build. Stuff always happens. And even after the home inspector comes in, they can't look at everything. So there's, they might miss something, and you're going to have some kind of with some money for it. Don't look at the home as an investment. Can you put 20% down, have money left over? A couple years ago, when I was just starting to build my practice before COVID, I met with someone who ran, he had a partner at one point, and they owned a mortgage company. They did well, and then they must have sold it, and he was managing an office for a larger company. I sat down with him. My perspective is you want to go in putting down 20% if you can. And he expanded my perspective because, not everyone's like that. We get people in a home for as little as 3% down. So it doesn't necessarily take 20%, which I thought that was a helpful discussion. And at the same time, I felt that he was kind of a shark. It's like, okay, you really want a home? All right, here's how you do it. We're going to play the game. You're going to pay this. You're going to put this much down on this one debt. We're going to play around with the numbers so that you can qualify and get in a home. Because remember, mortgage people get paid getting you in a home. Real estate people get paid by getting you in a home. So, for me, I think I always found that buying a home was very emotional, was less intellectual, was more emotional. So they feed on that emotion. So you don't necessarily have to put 20% down, but the less money you have in the home, it just makes it a little bit more risky. And you could pay for that either in private mortgage insurance. You could also pay for it in a slightly higher interest rate. And again, when you get in the home, do you have money left over to get into a home? And let's say it's a $250,000 or $300,000 home, after paying for everything and moving and all that, and you've got $1,500 in the bank. It's all about a matter of what risk is willing to take and what stress level. That would stress me out. Making sure your property's property insured, not just the value of the home, but also liability. It's icy, someone slips on your sidewalk, what happens? So one idea is, you get a home, and if you got the wherewithal, you always get better pricing on insurance when you bundle it with car and home. Think about getting an umbrella policy. And if I give a class on insurance, I'll cover umbrella policies, but umbrella policies cover over and above what would pay for the home and liability. Typically, umbrella policies cover up to $1 million, and it's usually, $200 to $400 a year. So it's a relatively inexpensive insurance policy. So make sure you're covered on liability. Things happen, and that you're in it for the long term. Refinancing. That's not as much a concern today because interest rates are so low. One mistake that we made, which is what I made, because I'm the one who did we refinanced once or twice based on different assumptions. And I kind of regret that, because once you refinance, you're resetting your mortgage clock. So I'll show you, give you some ideas of what that means. So here's some pros and cons, the pros of buying versus renting. You get to build equity. It might be tax deductible, some forced savings because you're building the equity, you're building some wealth in that regard. The payments are level. Of course, renting could be cheaper. You certainly don't have to deal with any down payment, don't have to do any taxes or maintenance, and much more flexible. In terms of the cons, it's just homes are expensive. Just before I got on here, we need new gutters. So I just got a guy come in and give us a quote on new gutters, which found out like $4,000 or $5,000, but I think they need them. So you get some more responsibility keeping the home up, because it's an investment in that if you want to keep it up so it retains the value. So that is one way. And of course, you have less flexibility. If you live a lifestyle of we want experiences, we want to come and go as we please, maybe home isn't the best idea, or at least not today. Rents, rents are rising. And that's a fact. And you don't build up, you walk away and all that money you spent on rent, you don't get anything for it. It's kind of like term insurance. You quit using it, it goes away. No tax benefit. And, you're living with more other people's rules that you may not want. So you decided we're going to buy a house, right? Let's do it. So now mortgage time. So I want to spend a little bit of time on mortgages. In 2000 to 2003, I actually built the sales department of a mortgage company. And so I probably looked at over 1,500 credit reports. So I learned a lot about that. So the thing that they're going to look at is your debt to income ratio. And there's two. There's a front end and a back end. The front end is housing cost. How much your housing going to cost relative to the income you have? And the ideal is that the ratio is 20%, 28% or less, that 28% of your income is going to housing or less. And then when they throw in everything else, that they want the back end to be ideally 36% or less. Also keep in mind, that's student loans too. And I know student loans can be a real killer, but they're going to look at that. They're going to look at they're going to look at everything. When you go for a mortgage, right, Jay? It's basically you're financially naked. They need to see everything. Any investments, pay stubs, bank statements, credit card statements, they look at everything. So so if you're thinking about getting a home, you want to know these numbers before you even start looking, because that's what, especially with this housing market, sellers are going to want you to be pre-approved. So you might as well know whether it's a good news or bad news before you start looking. So do the math. If you can play, there's mortgage calculators all over the internet. You can play with different numbers, but know your ratios, because they're going to know it. And this is kind of the range that once you start going above 28% on the front end and 36% on the back end, you become more risky, and it's going to reflect in the interest rates. It's just they perceive higher risk and also more hoops to jump through. And I can tell you this, that when it's time to go for a mortgage and when it's time to close on a house, this is what I learned. This is what I would teach and tell all my clients. We can have all your documentation in 2 weeks before the closing, but the people who process the loans, they process them based on the closing date. So they're not going to look at your stuff until a day or two before the closing. So be prepared to jump through hoops. It could be they always need one extra piece of paper. I remember it took me about 6 loans to learn that. So just be aware that no matter what, you could have some last minute things you're going to need to come up with. Interest rate perspective. I heard this week, there's a concern that maybe housing sales are going to drop off because the interest rate went up from 2.8% to 3.1%. Our first home, our interest rate, I think, was 13.25%. 13.25%. Okay. And inflation was high, and we still bought the home. So even if interest rates go up another percent or two, if it's going to be tight on your mortgage payment, then maybe that's a sign that maybe it might be time to step back and maybe save some more money. Okay. Interest rates are as low as they've ever been. They've stayed low. Even if they go up another point and a half, it's not 13%. Okay. So just keep that in mind and don't get freaked out. I mean, again, if that 1% bump puts you in jeopardy, step back and think, should we really be doing the home in the beginning anyway? So these are minimum scores. I went online. This is what I found. So conventional 30-year, 15-year fixed. You get below 620, you become riskier. And again, the ideal is around 740. You want a credit score of about 740. That's a credit. That's where you get the 3%, the 2%. You start dropping down below 700, it's going to get a little bit more expensive. And of course, you've got FHA, VA loans, jumbo loans. So there's all these different kind of loan combinations. And just you want to read up on them, but there's these different ones. The most common is the conventional loan. But if you're a veteran, it's some real benefits. And then with FHA, there's, you can get in with a lot less down, so there's some real benefits to some of these other programs, especially if you don't think you're going to qualify for a conventional loan with a top rate. So you want to look that over. There's also some first-time homebuyer programs out there. You want to research that, but there's ways of just be aware when you're going to look for the credit. All right. So principal payment, you got interest, you got taxes. And here's the thing to keep in mind, especially when I talked about refinancing, that let's say you get a 30-year fixed mortgage, 200 grand, 4.5%. The vast majority of your money for the first 15 plus years is going to interest. So if you've got extra money, and it's all about budgeting and a bit of financial planning, it's not a bad idea to add a little bit to your payment if you're able to. What it will do is it will shorten the back end. And another area is, like having a home equity line, but that's a whole different discussion. If you have questions about home equity lines, reach out to me and we can go over that. But just know that the first several years when you get into a mortgage, the bank gets theirs. They get theirs first before you start building really any equity. And that's another reason why you don't really want to refinance, because the clock resets. If you reset, 15 years down the road for another 30-year fix, you're going to go right back to the same situation, which we did. I regret, but it's, you live through those. So I wouldn't do that unless you had to. And try not to buy more house than you really need. I mean, if you plan on a growing family, you want to plan for that. But the more space you have, it's easier to fill it with stuff. And all of a sudden you've got a lot of stuff and you got credit card debt and you're going, why do I need all this stuff? So just all stuff to keep in mind. That's what I have. I love teaching. And I love getting paid to teach as well. So this is all I do. So I give group classes to organizations that are interested in financial wellness for their staff and their teammates. I do one-on-one coaching for people stressed out. They always walk away with a plan, and I'm right there with them, helping them, keep them accountable and working through the numbers. So it's not, they're not there by themselves. And that's what I've got. I hope it was educational. Hopefully it was worthwhile. I hope you step back and think, and I'm open to any questions you have.
Hey, Rick, this is Corey. I was kind of curious. This might be one step a little bit beyond, but for those that have already bought their houses and now that interest rates have tanked, what are the considerations you want to make in refinancing? I know one of your bullet points was be careful of refinancing, but how do you calculate when you're going to break even on what you lose in the closing costs?
Yeah, there's a couple of things. Okay, so if you don't mind, what's your interest rate?
From mine, I think I dropped down like at least 0.75. I forget off the top of my head.
Yeah, I would get. You got to run the numbers. You got to run the numbers, because also, how long have you been in the house?
I bought 3 years ago, and I'm saying this in hindsight. I refinanced last year.
Okay.
So, but going forward, if I need to look at either refinancing, either in this house down the line or next house, what are my considerations?
Man, I tell you, the interest rates are so low. I mean, if you go from like 7% to 5%, you're dropping a couple of percent. It's worth considering. It's worth considering. At the same time, know that the loan stretches out again, and that's the thing. Unless you can refinance, you go from a 30-year to a 20-year.
Yeah, which is what I did. So I took, like I said, at least 0.75% off, and it ended up, if I stayed at the same monthly payment, which I was comfortable with, I wasn't in over my head with the payment, I think I knocked 6 years off the term.
Okay, then that makes sense. Yeah, okay. It's really individual, and again, the interest rates are so low that, they're just fluctuating by what, a couple of tenths percent or 0.5%. It's really not enough, I don't think, generally, because you have, like you said, you have the closing costs. And if you go from 30-year fixed to 30-year fixed, you're just extending it. Now, like you said, if you were going from 30-year to 20-year, that's a different, it's almost, it's just still fruit, you know, so it's worth considering for that. Any other questions? Was that helpful?
Yeah, it was.
Okay. And you know, and you guys have questions later on, you just call me, email me. I'll take any calls, any questions, whatever I can do to help. That's it.
If nobody else has one, I have another one.
Shoot it out.
Go ahead, Corey.
I was just going to say one of the more confusing parts in looking and shopping around for a mortgage for me was buying points. What are the considerations on that, and when is that a good idea?
That is all about break even. It's all about break even. So if you're, let's say, again though, the rates are so low now. They're just ridiculously low. But let's say that you bought a point, and a point, yeah, I can't do the math quickly for you. It's coming down, how much does it cost to lower the rate? And what is the monthly savings? So if you're spending, let's say, $1,000 to lower the rate, and the monthly savings is $50, you know, it's what, 20 months of difference. So it comes down to really the break even.
Okay.
And you got to crunch the numbers.
Okay.
Typically, though, especially with rates so low, it's
diminishing returns to lower the rate.
Yeah, I wouldn't weigh it very heavily, but I'd still, if someone was interested in it, crunch the numbers, and the numbers will tell you. Maybe next time we'll do this in person, and we'll have beers. That's our thing, because I'm sure the next one's got to do something with beer, doesn't it, Jay?
You got it.
All right.
We've been working hard on our connections around the city, so that we can do some more events collaboratively with bars and restaurants and breweries and wineries, etc. So I actually had a couple of questions, Rick.
Sure.
So closing costs.
Mm-hmm.
Do you have a rule of thumb for preparing for your closing costs to maybe not be the same as what they told you ahead of time? I know when we got to our signing, we ended up having to write a $600 check because the number they had told us was off. So do you have a frame of reference for, be prepared to, plus or minus from the number they give you?
I'm wondering, the ideal time to close is the last day of the month. So maybe they thought you were going to close the last day of the month, and you closed a little bit earlier in the month because you've got that accrued interest. So I don't know if that's the reason, but just the ideal time to close is at the last day of the month. And so if it changes, that's probably one of the bigger reasons why it could change. Do you know exactly why it changed?
No, we were completely taken off guard. The only thing that saved us is our realtor had said, make sure you bring your checkbook just in case. But we were under the impression that the number we were given literally the night before was good. And then we got there and we had to write an additional check.
Yeah, I mean, the amount of paperwork, as you know, the amount of paperwork that is crunched. I don't know where the mistake came in, especially since you were given it the night before. That makes, I don't know. I can't explain that one.
Yeah, I didn't have the wherewithal to dig in too much. I was trying not to throw up. So
that's why it's good to have the emergency fund.
Yeah.
A little extra cash there.
The other thing then, do you have any thoughts on how much you should set aside for the difference between buying, say, a new home, a home that's maybe been lived in once, but it's, under 10 years old, and then a home that's, 30 to 50 years old, in terms of like your maintenance or emergency funds? Do you have any thoughts on,
My thought there would be make sure you get a good home inspector. The home inspector, that's all they do is look at homes, and then they should be able to help with anticipated expenses, especially like the HVA system, right? That's one of the more expensive, the roof. So I guess, you just got to go in knowing that there's going to be expense, but I think a good home inspector can help prepare you with what those expenses might be and when they might occur. Like this roof's got, a good another 10 years or 20 years on it. But just figure something's going to go wrong. And also another thing I recommend, and we still have, is a home warranty. Typically you get it for a year. The realtor or the seller will throw it in for a year. So if things are tight and you're not handy, home warranties, it's another insurance policy, but it's probably not a bad idea to consider anyway. Ours is, I think, $50 a month and like $100 deductible. We haven't used it for a couple of years, but water heater went out, HVAC went out, plumbing. So something to consider as it's an insurance policy.
Especially if you have older appliances in the house, like an older AC unit or older furnace.
That's right. 100%.
Last thing real quick, do you have any advice or rules of thumb on trying to figure out your future valuation, based on the area you live in, or is there any good way to try to, is this a good investment for the future based on where you live? You know what I'm kind of getting at?
Yeah. Well, in terms of Columbus, Columbus is growing. It's growing everywhere. And so, and there is a housing shortage. But but also it's kind of hard to, you've got that, but it's also what's your income future like? So buy a good home, buy in the neighborhood you like, buy the home because you love it and for what's around there. Buy it for the right reasons, and then don't worry about the future, right? 2 years ago, it was like pandemic, worldwide pandemic. What's that? That's science fiction. So, buy the home you like, that you love it, and for the right reasons, and the future will take care of itself.
Cool.
I hope it was time well spent for you guys.
Yeah, Rick, I have a question for you.
Sure.
So in general, I feel like a lot of different people say different things in terms of how long you might be in a home and should you buy versus rent. Obviously the flexibility of renting is nice with being able to move. If you think you're only going to be in an area for 3 to 5 years, is there a cutoff that you personally would say is where it makes sense to buy versus rent, or how would you look at that?
Yeah, 3 to 5 years is, more in the 5 year, because again, you don't know what happens. You're not, so you got to be prepared. What you want, I think, is to have enough equity that you need to get out, but the market's down. It's like, buying high and selling low. You don't want to do that. But
right.
You want to have enough years to have some equity in there to cover any downside, maybe.
Yeah, and the only reason I ask, to your comments that you've been saying here today, of there's the shortage here in Columbus, and so, but at the same time, it seems like there's nationally, it's sort of a seller's market right now. So our home's overvalued, or maybe we're still just going to see them continue to rise.
I think Columbus, we're going to see them continue to rise for a while, because they're just not built enough based on, and I was just on about affordable housing yesterday, a webinar. And if you've got the wherewithal, it's a good time to buy a house, but also it's very stressful, right? Because they put up a home for sale, you're competing against other people. So at some point, you don't want to price yourself out, and add extra stress. But I think Columbus is a good time to buy a home if one can find one and that fits their budget. We got a lot of good things going on in Columbus. So,
hey Rick, on that point, what about going in at, under, or over cost when you make an offer?
Shoot, talk to your realtor. I'm not a realtor, and a lot of areas are at. I'm not a realtor, talk to a realtor. I don't think you're going to get many bargains out there, but there aren't that many.
Yeah, in general, your realtor should have an idea of how quickly houses are going in the area, and based on their, they've got ways to analyze competitive houses to see, with this many bedrooms, this many baths, these amenities, how have the houses sold? Are they going, 15 over asking, et cetera, et cetera?
Yep. And of course the appraisal will tell you a lot too, which you will pay for.
Cool. Any other questions?
I appreciate the time. Again, hope this time well spent. And if you have other financial topics you're interested in, let Jay know. And if he wants to reach out to me, I'll do the research and come up with something hopefully that's informative.
Yeah, definitely. And Rick, we really appreciate your time and your expertise on these issues. I really wish we had done this session like a year ago. Because buying your first home is a lot of information that you've never seen before, and it is terrifying. But we really appreciate your time. If there's anything that you guys wanted to ask that you didn't get, again, go ahead and get with Rick or me. I know how to get a hold of him. If you have ideas for future events, let me know, either financially leaning or otherwise. We're always looking for and open to new events. We are recording this, so we will get the recording posted up on the Facebook group following this meeting. And then the last thing is just be checking that Facebook group for future events, and keep an eye on your email. Obviously, you guys saw the email, but keep an eye on your spam folders too. We've got an issue with emails going over to the spam folders at times. So thanks again for everyone's time, and we will see you at the next event.
Go Bearcats.
Yeah. Thanks, Rick. This has been great. Jay, thanks for setting this up.
My pleasure. My pleasure.
Yes. Thank you, Rick.
You're welcome. Have a good day.